Hi guys, so today we will cover chapter 15. So we have talked about options in chapter 14, so now we are continuing our journey in the derivative route of the financial market, and now we will talk about another very important derivative that you can actively trade on the market, which is futures. So let me share my screen and then we can start. So, chapter 15, futures market and securities. So future markets are where some of the most sophisticated investors operate, not because the assets are exotic, but because tiny price movements translate into huge gains or losses. So these markets take everyday economic forces like crop yields, energy supply, or interest rate expectations and turn them into tradable contracts. That means prices in the future markets often move faster and more violently than in the underlying cash market. So to navigate this environment, investors need a clear understanding of two things: how the market is structured and how trading in futures actually works. So over the next few slides, we will break apart the mechanics, what a future contract really represents, who participate in these markets, and why speculation plays such a central role in keeping the system liquid and functioning. So in finance, everything starts with understanding where a trade actually happens. The cash market is the simplest version. You pay today, you receive the product today, and the transaction is done. So future markets work differently. They separate the agreement from the actual exchange. When you enter a futures contract, you are locking in a price today for delivery that happens later, during a specific delivery month. So that makes a futures contract less about owing something now and more about managing risk over time. So buyers and sellers commit to a future transaction, and that commitment becomes a tradable instrument itself. So this structure allows farmers, airlines, manufacturers, and investors to plan ahead, stabilize their costs, or speculate on where prices will move next. One reason futures market feels so dynamic is that each contract effectively operates on its own schedule. Corn, crude oil, stock, index futures, each has distinct trading hours, and electronic platforms often extends those hours even further. That constant availability creates a near continuous flow of price information. To understand the scale you are dealing with, take the contract size and multiply it by the current quoted price. That gives you the market value of single future contract. Even modest movement in the underlying price can translate into very large swings because the exposure is so big. And crucially, all of this is traded on margin. You don't pay the full contract value upfront. You post a fraction of it as collateral, which dramatically increases both the potential return and the potential risk. Tables like this one are a reminder that the future contract is not a small instrument. It represents a huge quantity of the underlying asset. One corn contract controls 5,000 bushels. One crude oil contract represents 1,000 barrels. And the single S&P 500 futures contract can exceed $500,000 in notional value. This is why futures markets attract both hedgers and sophisticated traders. With one contract, you immediately gain exposure to an entire market's price movement. But the flip side matters just as much. Small changes in price can create a large dollar gains or losses because the contract size is so big. Understanding these dimensions helps investors choose contracts that match their risk tolerance and trading objectives before they ever place a trade. Options and futures look different on the surface, but they share a fundamental DNA. Both are agreements about a transaction that will happen in the future. Each links its value to an underlying asset and allows investors to take a view on where that asset price is headed. What connects them most clearly is the idea of locking in the price today for something that will be exchanged later. With call options, you secure the right to buy at a set price. With futures, you lock in the obligation to buy or sell at that price. But before we get into those differences, it's important to recognize the similarity. Both instruments give you leveraged exposure to future price movements without owning the asset today. So this shared structure is what makes them powerful tools for hedging and speculation. At a high level, options and futures both give you exposure to future price movements, but the risk profile could not be more different. With an option, you are buying a right, not a commitment. You choose a strike price, you pay a premium upfront, and then premium caps your possible loss. If the market moves against you, you simply walk away. Futures flip that logic entirely. There is no upfront premium, and you don't receive a right, you accept an obligation. If the market moves against you, your losses grow dollar for dollar with no built-in limit. That distinction explains why options attract investors who want asymmetry, while futures attract those who want pure, leveraged exposure without paying anything upfront. Understanding these differences is crucial before stepping into either market. Modern futures trading is dominated by a handful of powerful exchanges, and an understanding who they are helps explain how the entire market operates. The Chicago Board of Trade dates back to 1848, making it one of the oldest organized markets in the world. Over time, dozens of specialized US commodity exchanges emerged, but eventually the landscape consolidated. So today, the Chicago Mercantile Exchange, or CBOT, and the New York Mercantile Exchange, along with SOMEX, form the SME Group, the largest futures marketplace globally. This consolidated matters, so roughly 95% of all US commodity futures now trade under this umbrella. A single integrated exchange system means standardized contracts, centralized clearing, and a highly liquid environment where prices reflect information almost instantly. Every futures market depends on two very different groups of participants, hedgers and speculators, and both are essential for the market to function. Hedgers are the business exposed to real economic risks, farmers worried about crop prices, airlines worried about fuel costs, banks concerned with interest rate swings, and so on. By entering futures contracts, they lock in prices or rates today, transforming uncertain future revenues or costs into something predictable. That stability is the original purpose of their future market. But hedgers alone can't create liquidity. So speculators step in to take the risks hedgers want to offload. They seek profit from price movements, and by doing so, they make it possible for hedgers to enter and exit positions quickly and at fair prices. Together, hedgers and speculators create a balanced ecosystem where risk can be transferred efficiently. Trading futures looks a lot like trading any other financial asset. You place orders through a broker, you can buy or sell at any time, and you can use the same order types you already know from stock trading. But the key difference is what you buying or selling means. So going long is a commitment that benefits you when the contract prices rises. Going short benefits you when it falls. So importantly, neither position requires you to hold the contract until delivery. If you want out, you simply take the opposite position, buying to close a short or selling to close a long. That's why only about 1% of futures ever end in physical delivery. Almost everyone uses offsetting trades to realize gains or cut losses. The futures market is fundamentally about trading price movements, not shipping cattle, corn, or barrels of oil. Two simple metrics tell you a lot about what's happening beneath the surface of the futures market. Open interest measures how many contracts are still alive, positions that traders have opened but haven't yet offset or taken to delivery. High open interest usually means strong participation and deeper liquidity. So which makes entering and exiting positions easier. The second concept, round-trip commissions, is the true cost of trading. Because every futures position must eventually be closed, the cost of opening and closing the trade matters. Even small commissions add up when investors trade frequently or use multiple contracts. Together, open interest and round-trip commissions help traders judge how active a contract is and how much friction they will face when executing their strategies. Margin is the engine that makes futures trading possible. Unlike stock margin, where you borrow money, futures margin is simply a performance bond. You are not financing anything, you are putting down a small deposit to guarantee you can cover potential losses as prices move. So initial margin is posted when you open the position, and it's usually just a few percent of the contract full value. But that small deposit doesn't stay static. The exchange checks your position every single day through a process called a mark-to-market. Adjusting your account for gains or losses, so to speak. So if losses push your balance below the maintenance margin, your broker issues a margin call and you must add funds immediately. This daily settlement system keeps the market stable by ensuring that everyone can meet their obligations, even when prices move violently. So this table makes the concept of margin far more concrete. Look at how small the initial margin is relative to the size of the underlying contracts we saw earlier. So controlling thousands of bushels of corn or 1,000 barrels of oil often requires just a few $1,000s. So even highly valuable financial futures like the S&P 500 index require a fraction of the contract's full notional value. But that low barrier comes with responsibility. The maintenance margin ensures traders always have enough capital to absorb losses, and the exchange can adjust requirements as volatility changes. So when markets get turbulent, these numbers rise quickly to protect the system. Margin isn't a fee, it's a risk buffer that keeps both individual traders and the broader futures market stable. Commodities are the original backbone of the futures market. So long before financial futures existed, farmers, ranchers, and merchants were using futures contracts to manage the uncertainty of physical goods like grains, lumber, and livestock. These markets have been active for more than a century because the underlying economic problem hasn't changed. Producers face unpredictable prices, and futures help them stabilize revenue. At the same time, these contracts attract traders who want exposure to real economic forces, weather, global supply chains, energy demand, so without ever touching the physical products. In the next few slides, we'll look at the what makes the commodity tradable and how investors participate in these markets that blend physical goods with financial speculation. A commodity becomes tradable in the futures market only when it's fungible, meaning one unit is effectively identical to another. So this standardization is what allows buyers and sellers from around the world to transact without ever inspecting the goods. If the product meets the exchange specifications, its grade, purity, moisture content, or weight, it qualifies for delivery under the futures contract. That structure transforms messy physical markets into clean financial ones. Because exchanges define these standards clearly, investors can trade dozens of different commodities with confidence that every contract represents the same quality of product. So fungibility is the bridge that lets financial markets operate smoothly on top of physical goods. This table highlights the diversity of the commodity futures universe. Agriculture, livestock, and energy may seem unrelated, but they share one key trait. Each market depends on supply and demand forces that can shift suddenly. So weather patterns, disease outbreaks, geopolitical tensions, transportation bottlenecks, any of this can create large, rapid price movements. Futures exist to help producers, processors, and end users manage that volatility, while giving investors a chance to trade on these fundamental shifts. What's powerful here is how broad the opportunity set is. A trader can move from corn to crude oil to feeder cattle within the same exchange environment, gaining exposure to entirely different parts of the global economy. And commodities extend far beyond crops and energy. This table shows how diverse the futures landscape really is, ranging from metals like gold and copper to food products like cacao and orange juice, and even non-physical variables such as weather, interest rates, freight costs, and so on. So what ties all of this together is that each represents a source of economic uncertainty that businesses need to manage. A farmer may hedge against drought, an airline may hedge against jet fuel prices, and a shipping company may hedge freight rates. So the broader the set of risks that can be standardized and traded, the more useful the futures market becomes for both hedgers and speculators. So this diversity is part of what keeps futures market globally relevant and highly liquid. Every future contract is built on a detailed rulebook, and figure 15.1 shows what that looks like for corn. The exchange specifies everything: the contract size, how prices are quoted, the trading hours, delivery months, the quality of acceptable corn, and even the exact procedures for settlement. So this level of precision removes uncertainty and makes the contract completely standardized. When traders buy or sell a corn future, they know exactly what they are committing to. So 5,000 bushels of corn meeting a specific grade delivered during a defined month under uniform rules. So standardization is what turns a physical commodity into a highly liquid financial instrument that can be traded quickly and globally. Without these specifications, the futures market simply couldn't function. A commodities contract may look simple, but it's built from several key components that ensure clarity and fairness in trading. So the contract spells out exactly what product is being traded, how much of it is included, and on which exchange the contract is listed. It also specifies how prices are quoted, whether in cents per pound, dollars per ton, or another unit, so traders can interpret prices movements instantly. The delivery month anchors the contract in time, but the most important number for traders is the settlement price. So the final price of the trading day. Exchange use this price to calculate gains and losses and adjust margin accounts through mark to market. Volume, meanwhile, tells you how active the market is on any given day. Each of these details helps transform physical commodities into standardized, liquid financial instrument. So this quote screen is the real-time heartbeat of a futures market. Each row represents a different delivery month for corn, and each column gives traders critical information. The last price shows the most recent trade, while change reveals how that price compares to the yesterday settlement. Prior settle anchors today's mark-to-market calculations. Open, high, and low price show the trading range for the day, and volume tells us how active the market has been. Even the timestamp matter. They tell you exactly when these prices were updated. A screen like this allows traders to track liquidity, volatility, and momentum all at once. With just a glance, you can see which contract months are most active and where prices pressure is building. Commodity prices behave very differently from stocks or bonds because they respond to forces that are often sudden, unpredictable, and global. A drought in Brazil, a refinery shutdown in Texas, a trade dispute with China, any of this can move commodity prices sharply in a single day. And because futures contracts represent large quantities, even a small price move can translate into thousands of dollars gained or lost. So this sensitivity is exactly why investors are drawn to commodities. The combination of real-world fundamentals and high leverage creates both opportunity and risk. So understanding these drivers, weather patterns, geopolitical tensions, transportation issues, and global supply and demand is essentially for anyone trading commodity futures. So commodity markets are known for their sharp, sometimes extreme price swings. and exchanges put protective mechanisms in place to prevent disorderly trading. One of those most important is the daily price limit, which caps how far a contract price is allowed to move in a single trading session. This prevents sudden shocks like a weather disaster or geopolitical event from spiraling into panic. Beyond that, exchanges also set a maximum daily price range, typically twice the limit, which defines the outer boundary for intraday movement. So these guardrails don't eliminate volatility. They just slow it down enough to protect traders, ensure orderly markets, and give participants time to reassess information before taking further actions. Commodity futures don't pay dividend or interest. The entire return comes from price movement. So that means your profit depends solely on buying low and selling high, or vice versa. What makes this market compelling is how leverage magnifies those gains. Because you only post a margin deposit, often a tiny fraction of the contract full value, your percentage return is calculated against that small upfront amount. So equation 15.1 captures this idea. Take the difference between your selling and purchase price, then divide it by the margin you invested. When price swings are large and contract sizes are big, even a modest move in your favor can produce an exceptionally high return or invested capital. But the same leverage works against you if prices move the wrong way, which is why futures trading requires discipline and risk management. Commodity trading really boils down to three distinct approaches. Speculating is the most straightforward. Traders try to profit from the large and frequent price swings that characterize many commodity markets. It is high risk, high reward. Spreading is more strategic. Instead of betting on the absolute direction of prices, traders combine long and short positions in related contracts. So this lets them capture pricing relationship while producing overall exposure. And finally, we have hedging is the original purpose of the futures market. Producers, processors, or companies with real business exposure use futures to lock in price and protect profits. So hedging isn't about making money, it's about avoiding surprises. Although individuals often gravitate towards speculating or spreading, all three strategies play crucial roles in keeping the market balance. Speculating and spreading are the two main strategies individual traders use in commodity futures. So speculators take directional bets, going long if they expect prices to rise or short if they expect them to fall. So their goal is simple: profit from volatility. Spreading, on the other hand, is more controlled approach. Here a trader buys one contract and simultaneously sells another, often in a related commodity or a different delivery month. So the idea is that gains on one leg will offset losses on the other, leaving a smaller, more stable net exposure. So spreads won't eliminate losses entirely, but they can soften the impact of major market swings. So this makes spreading appealing to traders who want exposure to commodity price movements without taking on the full risk of a single direction bet. Financial futures extend the logic of commodity futures into the world of financial instruments. So instead of corn, cattle, or crude oil, these contracts are tied to currencies. So instead of interest rates and stock indexes, for example, the mechanics are identical: standardized contracts, margin trading, and daily settlement. But the underlying risk comes from movements in the financial markets rather than physical supply and demand. Financial futures give investors powerful tools. They can hedge exposure to interest rate changes, speculate on currency movements, or adjust equity market risk quickly and cheaply. Over the next few slides, we will explore how these markets operate, the strategies traders use, and why financial futures have become essential tools for both institutions and individual investors. So, financial futures give investors a way to manage risk that come directly from the financial system, interest rates, currencies, and stock markets, for example. Institutions rely heavily on these contracts because even small movements in rates or exchange values can affect billions of dollars in assets. A bank might hedge against rising interest rates, while a multinational corporation might hedge against a weakening foreign currency. So individual investors also participate, often to speculate on macroeconomic trends. The market is built around three core categories. Those are currency futures, which track major global currencies, interest rate futures tied to government bonds and money market instruments, and stock index futures, which move with broad equity markets. Each category offers a different tools for adjusting portfolio risk quickly and efficiently. Financial futures cover the core drivers of global financial markets. So currency futures let traders and companies manage the risk of exchange rate movements, crucial for anyone dealing internationally. Contracts are available on all major currencies, from the British pound to the Japanese yen. Interest rate futures are tied to debt securities such as US Treasuries or Eurodollar deposits. These contracts are vital for banks, pension funds, and anyone exposed to rate fluctuations. Finally, stock index futures allow investors to gain or hedge broad market exposure instantly. Whether it's the Dow, the S&P 500, the Nasdaq 100, or the Russell 2000, these contracts track entire market in one trade. So together, these three categories form the backbone of the financial future landscape, so to speak. Financial futures follow the same structure as commodity futures, but the underlying assets are financial instruments, indexes, currencies, or interest-bearing securities. So these contracts control large sums of value, giving traders substantial market exposure with relatively small margin deposits. Delivery months vary, allowing investors to target specific futures periods of interest. One key difference across categories is contract lifespan. Stock index and currency futures typically run 12 months or less, reflecting fast-moving markets and frequent rollovers. Interest rate futures, however, may extend 2 or 3 years or more, matching the longer-term nature of bond markets. So understanding how long each contract lasts and when it expires is crucial for managing risk and timing trades effectively. Different types of financial futures settle in different ways, and that reflects the nature of the underlying asset. So a currency futures contract gives you a claim on a fixed amount of foreign money. So at expiration, you're effectively exchanging one currency for another. Interest rate futures work similarly, except the claim is on a debt instrument like a treasury bond or Eurodollar deposit. But stock index futures are different. You can't deliver the S&P 500 or Nasdaq 100 as a bundle of all their component stocks. So instead, these contracts settle in cash. Your gain or loss is simply the difference between the contract price and the actual index level at expiration. This makes equity index futures extremely efficient because no physical transfer is required, yet they still track the market with precision. This figure shows quote screen for three major types of financial futures: currencies, interest rates, and stock indexes. Even though the underlying assets differ, the structure of the data is the same. For the Canadian dollar, you see the futures price quoted in the US dollars per Canadian dollar, along with the change from the prior settlement, today's high and low, and the current volume. So the Treasury bond futures quotes show similar information, but priced as a percentage of par value. And the E-mini Dow futures display the index value that the contract tracks. By standardizing the format, exchanges make it easy for traders to compare liquidity, volatility, and market direction across completely different asset classes. So the consistent layout highlights one of the strengths of future markets: transparency and real-time information across a wide range of instruments. Financial futures quote prices in a way that mirrors the underlying asset. Currency futures are quoted in US dollars or cents per unit of foreign currency, Interest rate futures are quoted as a percentage of a bond par value, and stock index futures simply mirror the level of the index itself. So even though these formats differ, they all serve the same purpose. They show the market value of the futures contract at the moment. And because futures don't pay dividends, coupons, or interest, every dollar gained or lost comes entirely from the price behavior. So when you combine that with the leverage built into margin trading, the result is clear. Small movement in the quote can translate into huge profits or equally huge losses. This is why financial futures are powerful, but also why they must be used with precision. Speculating with financial futures is all about using leverage to control a large amount of financial asset with relatively little capital. Instead of buying the underlying stock index, bond, or currency outright, traders use futures to amplify their exposure. A small move in interest rates or equity prices can translate into a big percentage gain or loss because the contract's notional value is so large. The mechanics are straightforward. You go long if you believe the price of the underlying instrument will rise, and you go short if you believe it will fall. This ability to profit in either direction, combined with the powerful of leverage, is what makes financial futures such appealing speculative tools. But it also means that mistakes are magnified, so successful speculators rely on discipline and tight risk management. So stock index futures are powerful tools because they let investors act on broad market views instantly. Traders who think the market will rise can go long, while those expecting a decline can take a short position without buying or selling a single share of stock. So for hedgers, these contracts offer protection. A portfolio manager worried about a downturn can short index futures to offset losses in their equity holdings. Beyond equities, other futures markets extend this hedging power. So interest rate futures, for example, allow investors to protect bond portfolios from rising states, while currency futures help companies and individuals shield themselves from foreign exchange risk. Whether for speculation or risk management, financial futures provide quick, cheap, and targeted ways to adjust exposure. Financial futures can be valuable tools for individual investors, but only under the right conditions. So these instruments amplify both gains and losses. So before using them, an investor needs a deep understanding of how futures work, margin, leverage, daily mark-to-market, and contract specifications. It's also essential to acknowledge the enormous risk exposure. Unlike buying stocks or bonds, futures can move against you quickly and force rapid losses. So finally, investors need the emotional and financial capacity to absorb those losses without panic. When used responsibly, financial futures can hedge risk, adjust portfolio exposure instantly, or provide targeted speculation. But without preparation, their volatility can be overwhelming. Options on futures blend the flexibility of options with the power of futures contracts. So a call option on a future contract gives the holder the right, but not the obligation to buy a specific futures contract at a preset strike price. A put option provides the right to sell that futures contract instead. So these options exist on both commodity and financial futures, giving investors a controlled way to take directional views. The key advantage is risk management. So unlike a future contract where losses can be unlimited, the maximum loss for an option buyer is simply the premium paid. You still gain leveraged exposure if the futures price moves in your favor, but your downside is capped. So this limit risk structure makes future options attractive when uncertainty is high or when traders want exposure without committing to the full obligation of a future position. So this option quote screen shows how futures options add another layer of flexibility to the corn market. At the top, you can choose the contract month, option type, expiration date, and whether you want to view strikes that are in, at, or out of the money. Below that, the table splits into calls on the left and puts on the right. So each strike price has its own last traded premium, change from the previous day, and high-low range. So these premiums represent the cost of buying the right to take a position in the corn futures contract. Because options have limited downside, your maximum loss is the premium paid. Traders use them to express the directional views or hedge existing futures positions with controlled risk. So this quote display lets traders compare dozens of strikes at once, helping them find the best balance between costs, risks, and payoff potential. And I think this is the last slide. Yes. So this chapter, as I said, was about futures. Thank you guys for listening, and hope to see you in the class. Bye-bye.